Hello, everyone. We are at 1 p.m. Eastern sharp. So thank you for being on time here. We'll just take a few seconds to let everyone pop in. Um, so thank you so much for making time in your busy schedule to be here with us today and for making a choice to invest in yourself and your practice by joining today's CE-Accredited financial planning session. This is part 2 of our deep dive into the 2025 IAFP Symposium case study, One Plan to Rule Them All. Don't worry if you missed part 1. They're 2 separate sessions, and this one is going to be a little bit more advanced than the first one. Throughout this hour, you will have to answer 3 poll questions in order to qualify for the applicable credit for today's session. I will be supplying your names and email addresses along with the poll question responses directly to the folks at IAFP, as they will be the ones providing the certificates. They typically aim to have them out in 1 week's time. And in addition to the CE credit, we do have a special offer which will be shared at the end of the session. My name is Alex Mercer, and I'll be your host today. I'm joined by my colleague, Steve Arnott, Snap's Financial Planning Project Lead, who will provide today's demonstration and run the Q&A.
Hello, everyone. Thanks for joining us.
I'm going to pause here just for a moment to do a quick tech check to make sure you can all hear us and see the screen. Can you send me a quick yes or even a smiley face through your Q&A tab? This is exactly how you'll send any questions you have throughout the session. I'll be using the chat tab, and that is where you will find the symposium case study. Do we have any responses coming in, Steve?
Yes, lots so far. Thanks so much, everyone. Lawrence, Grace, Cameron, we're good to go.
Fantastic. Thank you. And I just dropped the PDF link to everyone in the chat in case you don't have the symposium case study. I will send that out via email as well, just to make sure everyone has it. So Steve and I have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation. So today is part 2 of this series. The objective of part 1 was to introduce you to the software. Today, we will build out the full case study for Aragorn and Arwen. Through this process, we will be able to model and compare highly personalized outcomes to ensure we help Aragorn and Arwen make the best possible choices moving forward. Many of you here today already know us, but for those of you who do not, Snap Projections provides transparent, easy to use, and highly flexible financial planning software for Canadian planners and advisors. This product continues to be developed with advisors for advisors. Advisor input and involvement is how we continue to bring what you need to market. If you want to hear from other advisors who are already using Snap, you can find reviews numerous places online. For example, on Capterra, which is an independent third-party software review site, you will find advisors saying things like none of their clients retire without a Snap projection, and that the software has become foundational to their firm. As you can see, we are currently sitting at 4.9 out of 5 stars. We have been in market for 10 years, enthusiastically serving the thousands of financial advisors, planners, and investment managers who partner with Snap to grow their assets under management and increase quality referrals. So we have got a lot to cover today. So let's get started with our first poll question. And hopefully this is going to be an easy one to get us started. So you should see this launching on your screen now. Who are we helping today? Is it Aragorn and Arwen, Gandalf, Sauron, Bilbo Biggins? And please forgive me if I have mispronounced any of these names. Okay, we will give you a few more seconds here. Get your answers in. 100% of you are answering this question correct. So I'm very happy to see that. Just a few more seconds here and we will move on. So just do a quick countdown. Get those answers in. They are still coming. 5, 4, 3, 2, 1, and we are going to end the poll and move on. If you're here and you're having any sort of technical difficulties, please just shoot me an email later or through the Q&A tab, and I will make sure we get your answers in. Perfect. So with that, I'm going to hand it over to Steve for our In Software Learning.
Terrific. Thanks, Alex, and thanks again, everyone, for joining us today. Snap Projections is a web-based platform, which means you can access your account from any computer without needing to download anything. You'll go to snapprojections.com, and then in the top right corner, you'll have the option to click Login to enter your username, password, and the option for a multi-factor authentication. I've done that during today's session, so I'll click Login and go directly into the software. I'm taken initially to my clients page where I can access any of the projections I've created in the past, or I can get started on a new client file by clicking Add New Client in the top left. As Alex mentioned, we're going to be creating a series of projections today for Aragorn and Arwen. They're currently aged 60 and 65. They recently adopted 4 hobbits and are living in BC in Canada. So we'll enter in their personal information and get started on the plan. All right, now that we've entered in our client's base data, you'll see in the top left corner of the software that there are 3 main sections to the tool. The first is the scenario setup, where we enter in all of the base plan data. This includes our client's information, general plan settings, expenses, incomes, assets. Once we're done with the scenario setup, we'll then proceed to the planning pages where all of that information comes together to show us our client's lives on one page. From here, we can review information, make any changes that we'd like, and then once we're comfortable with all of the numbers, we'll proceed to the client report, where we can create the custom client deliverable that we would like to include, customizing all of the charts, tables, and commentary. For now, we'll continue on with the scenario setup. I'll click Next at the bottom, and we'll go to the general plan settings. Because we're approaching the end of the calendar year, I'm going to start this projection as of 2026. We have a target retirement for Aragorn of 61, which will be the start of next year, and Arwen's been retired since she was 65. We're going to run the projection until age 98 for each client. And then we have the FP Canada guideline assumptions for inflation. And we've taken the FP Canada guideline assumptions for gross returns and reduced those by management fees to arrive at a net assumption. I'll click Next and go to the expenses page. There's quite a bit of flexibility for expenses in Snap. You can enter in expenses directly on some of the settings pages. So for instance, their mortgage, you'll enter on the debts page. And then you'll also have the option to enter in a total annual spending need. So this would be things like their property taxes, groceries, transportation, expenses that are expected to occur every single year going forward. And then there are the additional expenses where we can itemize values and have a more detailed conversation about goals. And you can either enter in these values yourself, or you can have Snap help you calculate them. In this case, we do have a target spending goal, which is $120,000 per year. Plus, they have fairly high upkeep costs for their castle. And that's $40,000 per year. And we're going to itemize that because if they do decide to sell their castle at a future year, we can stop those expenses at that point of the plan. So you'll see we can enter a from age and a to age. In this case, we'll leave them both blank because we want this to apply for the full projection. But if in the future we sell the castle, we can enter in a to age and stop that expense. We'll also highlight it so that in the reports, we can see that as a specific line item and have a conversation about the impact of those expenses on the plan. I'll click next and go to the incomes page. For Aragorn, he's no longer working as of next year, so we'll delete the employment income. And he doesn't have any pensions or other sources of income in the future, aside from his assets and government benefits, which we'll include on those pages. In the top left, we can toggle back and forth between our clients. So we'll go to Arwen's page. She similarly is retired, so there's no employment income, but she is expecting to receive the proceeds of an inheritance in the amount of $600,000, and that's expected to be received at age 66. So we can enter in from age and to age both as 66, and that's going to create a 1-year cash flow of $600,000 into Arwen's name in the plan. She also has an Elvin pension, and that's currently providing $84,000 a year with a 60% survivor benefit and a full indexation for inflation. You'll see that SNAP allows you to enter in a pre-age 65 value and a post-age 65 in case there's a bridge benefit and the client is starting the pension before age 65. I'll click next and go to the assets page, and we'll start with Aragorn's assets. You'll see that SNAP adds a default non-registered to all plans. This shows you how you can add financial assets and also gives the software a location to allocate future surpluses. I'm just going to repurpose this and call it joint checking. And the value is $115,000. And that's joint, 100% in cash. And you'll see SNAP has pre-populated the rate of return for each of the assets based off of our general plan settings, but we can always customize on an account by account basis. So in this case, we're going to set the rate of return to 0 because it's currently in a checking account. We're also going to add their personal savings of $15,000. That's in a savings earning 1%. They also have a tax-free savings account with $140,000. And that's invested 30% fixed income, 70% equity, and we can see the total blended return calculated by SNAP. Aragorn also has an RSP with $975,000. And he has a locked-in account with the BC jurisdiction for a total of $850,000. Now that we've added the accounts, we can see across the top of the table, there are tabs for each of the registered account types. And this is a common theme throughout SNAP, where you can create quick and simple projections without diving into the subsettings. In that case, SNAP is going to use conservative default assumptions, or if you really want to tailor the plan for more complex, unique client circumstances, you can go into those subsetting pages and customize the assumptions. So in this case, we have the ability to enter in any carry forward contribution room that the clients might have. So in this case, they're all caught up. So we just want the 7,000 of new room for 2026. We can also indicate that we want to maximize the TFSAs over time, pulling from non-registered accounts automatically. For the RSPs, we can enter in contribution room, pension adjustments, and set the conversion age, as well as the minimum RIF calculation. Now that we've entered Aragorn's information, we'll go to Arwen and we'll do the same process. So I'll delete the default. We've got the joint checking. She has a personal savings as well for $23,000. She also has a tax-free savings account for $150,000. An RSP for $325,000. And then a large non-registered account with a unrealized capital loss. So the current value is 1.215 million, and the cost base is 3 million. So again, once we've entered in the accounts, we can tab through the various account settings to see if we want to make any adjustments. Similar to Aragorn, the only thing we want to do is ensure that the software is maximizing out the TFSA automatically. We can then scroll down to the real assets section and enter in their castle, which has a current value of 3 million and a cost base of 2 million. And that's a joint asset, which is their principal residence. If we wanted to, we could show the future sale or purchase of a property if they're going to downsize or if they want to save up for a new property in the future. They don't have any debts at the moment, so we'll go straight to the government benefits page, and we'll go back to Aragorn to start with. By default, Snap will assume the client starts CPP when they retire. In this case, we're going to show in our base scenario starting at age 65. And then because Snap doesn't have all of the historical contribution data it needs to calculate the client's CPP, we use the national average of 57% as the default. But because Aragorn's earned at a high level all of his working life, we're expecting closer to 90%. So we can either enter in a percentage or a dollar value depending on what information we have. And then OAS, we're going to start at 65 with an expected 100% value. Going to Arwen, we can make similar adjustments. She already started taking CPP last year, and she's receiving the full 100% maximum, and similarly receiving 100% of the OAS. And just like that, in about 10 minutes, we've finished the scenario setup for these particular clients. On the left, you'll see that we do have additional pages available. We could add insurance policies. So if we gathered more information from Aragorn about his whole life policies, we could enter that here. We could add our ESPs and customize additional settings as needed. This includes things like portfolio settings that determine how Snap calculates the non-registered taxable income on investments. We have the ability to customize credits and deductions and benefits. So lots of options to really dig into plans and customize more nuanced assumptions and calculations. And then we can also add charitable donations and corporations to the plan. But for now, we're finished with the scenario setup. I'll click on planning pages in the top left, and we'll see how all of this information can come together to show us our clients' lives on one page. Now, the planning page can seem overwhelming the first time you're interacting with it, but it does become quite intuitive and is the most powerful section of the software. On the left, we can see our year and the client's age. Then we have the target spending of $120,000 per year, and that is automatically indexed over time at the rate of inflation. We can see the upkeep for Castle of $40,000 gradually increasing. We have the income of $600K, and you'll see each of these sections are collapsed to save room, but you can expand them in order to get more information. So that's the inheritance. If we expand the benefits, we can see there's CPP, OAS, some clawback. We have taxes payable, and then we have information about the client's financial assets and where Snap is either contributing or withdrawing from each year. So we can see in the first year of the plan, Snap is depositing $538,000. That's the net of the inheritance that's remaining after using some for spending in the year. It's topping up the TFSA, and then it's withdrawing the LIF minimum from the account. We can then see the value of the castle growing over time, their net worth, estate, and estate tax information. And we can see that for the first year all the way down into the future to the final year of the plan when Aragorn turns 98. So we can see as of that year, the inflation adjusted spending is $258,000 plus castle upkeep of $86,000. And that's being funded through a combination of withdrawing out of the non-registered account, withdrawing out of the RIF and the LIF. And that's leaving at the very end of the plan, roughly $14 million in future dollars. We can also review the plan in the form of charts. So if I come up to the top and click on charts, we can get a visual understanding of what's happening. So in the first year, we have a large spike of contributions to the financial assets using up the inheritance. We have the base expenses of $120,000, the upkeep for the castle, income tax, contributions, and then any other outflows such as top-ups to the TFSAs. Then we know where the money is coming from, whether that's an inheritance or non-registered withdrawals. And we can also interact with any of these charts. So if you don't want to skew the y-axis, you can remove the inheritance. You can also add a note in the report just itemizing that there was an inheritance received, but it's been removed from the chart. So lots of flexibility in order to interact with the charts, update the view, and just make sure that you have the information that you need for your client discussions. So now that we're finished with the base scenario, I want to go over the goals of today's engagement with Aragorn and Arwen. So we want to help them to understand how they can support their new family and retire with peace of mind. So the first step to that is to create a fully customized financial projection to show them expected incomes and expenses over time. So that's what we've done here. We've factored in all of their most likely expenses, incomes, and expectations in the future to give them a base understanding of what might come in the future. The next step is we want to model in additional support for their children to illustrate the impact on their finances. So one of their largest stressors right now is that they've adopted these 4 hobbits and they want to make sure that their children are successful over time. Each of them face different challenges and have unique opportunities ahead of them, and they want to make sure that they're able to support those needs. So we're going to update this first scenario that we created. So I'm going to click on the title. I'm going to change the scenario title to Scenario 1, Current State Retirement. And then I'm going to click on the menu in order to copy this base plan, and then we'll make some adjustments to reflect additional support for their children. So I'll click again on the title, update it to Scenario 2, and now we have 2 copies. If I click on the client's name, I can navigate back and forth between our current state and an additional support for children. So there's a couple things that we're going to model. If you did attend our first session, you'll remember that when we were planning for Sam and his family, one of the potential strategies that was being considered was for Sam to take a loan from his parents in order to repay his high interest business loan and be able to pay off the debt at a much faster rate. So we're going to model the other side of that transaction for Aragorn and Arwen. To do that, we'll go into Assets, and then we'll go to Arwen's page. We'll go down and add a new financial asset, which we'll call Loan to Sam. And so there's no outstanding balance as of today. So we're just going to add kind of a placeholder for a new loan. And that's going to be 100% fixed income with an interest rate of 3%. Then we can go to the planning page and we can customize the cash flows in and out of that asset over time based off of our expected plan. So we have this new Loan to Sam. Instead of taking all of the inheritance money and investing it in a similar portfolio to what they have today, we can show them contributing $350,000 into the Loan to Sam. And then Sam would repay that loan at $48,000 a year. So essentially, from Aragorn and Arwen's perspective, it's the equivalent of an asset that's going to pay 3% per year in interest and then gradually be repaid and stop in the future. And so this is using up some of the inheritance money. We can see that Snap automatically reduces the amount deposited to the portfolio, and then we're withdrawing that cash flow, which is then being used for spending or other contributions. Snap is also going to calculate the appropriate interest each year based off of the principal and how much they're charging Sam. In addition to the loan, they also want to provide various cash transfers to their children over time. So we're going to add a new expense, support for children. And they're expecting about $90,000. And that's a combination of an allowance for Pippin, support for Frodo, gifts to Merry, and then any other help that Sam might need with his business adventures. So we'll enter that as a joint. And then we're just going to run that until Arwen's age 75, which is another 10 years of the plan. So we'll have about $900,000 total expenses being paid out to the children over the next decade. So now that we've entered in those additional details, we can go back to the planning pages, and then we'll go to the combined view in order to get a high-level assessment of how that impacts the projection. So now we have the support for children of 90,000 indexed for inflation for 10 years. We can see that Snap is automatically increasing the withdrawals from financial assets to fund that cash flow. And then if we scroll all the way to the bottom, we can see that their net worth is now closer to 11 million instead of the initial 14 million. So this does suggest that they should be able to provide fairly substantial support for their children while still being on track for their target retirement. But as we know, the plan that we've currently created is not a guarantee. The rates of return, the inflation assumption, there are lots of things that could go off track. And so we want to make sure that by supporting their children, they're not overextending themselves and potentially exposing themselves to a down market. So we're going to create a stress tested plan with lower than expected real returns. So we'll go back into Snap and we're going to click on the menu option again and then copy the second scenario. And then we're going to click on the title and we'll call this Scenario 3, Support for Children with Low Real Returns. And we'll save that. So if I expand the financial assets section, we'll see that there is a rate of return assumption for each account based off of the asset allocation that we indicated earlier in the scenario setup. And we can do a couple of things. We could change the rate of return in any future year of the plan. So if we wanted to, we could take the TFSA and change the allocation or change the rate of return. Or we can also use the stress testing module in order to apply historical returns or randomized returns to have a discussion with the client about variability, sequence of return risk, and the impact of lower than expected returns. So I'm going to click randomized scenario. And then you'll see that Snap creates a sequence of future rates for both inflation, cash, fixed income, and equities. And then it allows you to pick from a worst case scenario to a best case to a middle to anything in between. So in this scenario, I'm going to use the 20th worst case, and I'm going to assume that they have roughly a 30-70 allocation, which is what most of their assets are using. So the 20th worst case out of the 100 that are available to us, and I'm going to update to see what that looks like. So in this case, we can see they have some strong initial performance and then a major correction and then some strong performance again. And I can randomize and update as many times as I'd like if I'm looking for any particular type of market circumstance. So let's say that I want a down market right as they're retiring. That's more so what this is showing, equity performance of negative 10% over the first 5 years. And then it recovers later on. But if the clients have already used up a lot of their assets, they wouldn't be able to take advantage of these later year returns. So Snap factors in all of the randomized sequences, and we can apply that to our projection. So now if we take a look at the projection, we can see that the rate is changing on a year-by-year basis, again, based off of the asset allocation of the account and the resulting rates that were created in our randomized scenario. So if I go back to the combined view and I scroll towards the bottom and I collapse the financial assets again, now we can see that their final estate is closer to 9 million, which is about 2 million less than our last scenario. So this is a great way to have a discussion with the client about what sort of variability they should expect. So we can see a range of outcomes. So positive 15%, -3, -11. So it gives you a sense of what they can expect going forward. And then it also gives you a range of impacts on their estate or spending ability if they were to live through that lower than expected return environment. So now that we've created our 3 scenarios, we can go to the menu option and we can compare those plans across a wide range of customizable metrics. So if I click Compare Selected Scenarios, I now have the 3 plans. So I have Scenario 1, Current State. In that case, we had a significant overfunding, lots of buffer in the plan. They had about 83% more in liquid assets than they needed. Once we added in the support for children, we can see that dropped to 153% of their need. And then with lower returns, it dropped to 130. And we can see where those changes came from. So whether that's changes to taxes, changes to spending assumptions, and we can also see the impact that would have on their final estate. So initially they have 8 million buffer in investments, then 5, and then 2.6. And this is a summary of the whole plan all the way to the final year of the projection. We can kind of compare the outcomes at the very end, or we can go into the trends view and we can see the differences for each plan every year going forward. So we have our initial scenario where things were quite rosy, then we added in some more expenses, and so their final estate would be lower. And then with lower returns, we can see both the variability in estate outcomes and the lower long-term expected outcomes. So we have now been able to address the first 3 points. We created a custom scenario, we modeled the additional support, added in some stress testing, and now we want to discuss the potential use of equity from their castle if required. So even though all 3 scenarios we've created has shown them with surplus at the end, they might ultimately decide that they need more than 90,000 a year of support, or they may want to live more vacations or something else, so they could add additional expenses to the plan. And if they ever did need to use equity in the home, we could show that in a couple different ways. We could go into scenario setup and then to the assets page, and we could enter in a future sale age for the castle. If we did that, we could either add in a new property purchase if they were going to downsize, or we could add in an additional expense that starts in a future year, either for rent or assisted living or long-term care or whatever the case might be. So lots of flexibility to show future transactions and how they can incorporate use of their home equity into the projection. And as another option, they could also borrow against the home equity using a line of credit or reverse mortgage. So once we're finished with all of the analysis and our discussions with the clients, we would then decide which scenario we want to use for further planning. So in this case, we're going to go ahead with scenario 2, which is support for children, but without the stress tested return. So we've kind of talked about the outcomes of the stress testing, and if we wanted, we could go back into the compare scenario and we could always generate these as standalone reports that we can share with the client. So we could print the table, or we could print the chart so that they understand how different assumptions would impact their outcomes over time. So you can always include the scenario comparison as a deliverable. But in terms of the full-on planned report, we're going to use the scenario 2 with static annual returns, and we're going to go into the client report so that we can walk through the process of customizing that fully. So if we go to the report builder, you'll see that we have lots of charts and tables available for you to select from. It's not to suggest that all of these should be included in every report. It does end up being quite long if you were to do that, usually between 40 and 60 pages. It's more so just to give you lots of options for support if you have specific client needs in the future. So for instance, if you want a net worth projection for the household, that's available, but you can also look at a net worth projection for each of the clients individually. So you can typically remove the individual versions if the clients aren't looking for that level of granular data. So I'm going to go from the top to the bottom. I'm going to customize the report pages that we include. Then I'm going to customize what content is on each page, and then we'll show you the final client report for our client scenario. So we've got our cover page, our note to reader. Then we have the snapshot section, which is a high-level executive summary of the plan. It allows you to have multiple charts and tables on one page to kind of give a quick summary of what's to come so that clients have context as they move forward through some of the more detailed pages. You can include all 10 if you want, or you can reduce it down to 6 if you want to fit them on one single page. So I'm going to get rid of 4 out of the 10 summary options. And I'm just going to do that based off of this particular client case and what we want to include. So I'm going to drag the page from the included section into the gallery, and then it will be there for me in the future if I ever want to access it again. I'm also going to get rid of financial asset flows, the expense summary, and the recommendation summary. And then in addition to getting rid of pages or adding them, I can also reorder them. So I'll take the net worth statement summary and move that down beside the final estate information. And then we get into the larger, more detailed pages. So this is the goal details. I'm going to get rid of that because we've already included a goal summary in our snapshot section. I'm going to leave the assumption details. I'm going to get rid of the cash outflow. The cash inflow chart. And I'm going to Sorry, I'm going to leave the charts. I'm going to get rid of the cash inflow details, which is essentially just a table version of the chart. And you have your choice to pick which ones you want. We do have recommended sample reports. So if you go to our help site, you can find in our help center the templates and recommended report pages to include based off of all of our conversations with advisors in the past. You can also always search for answers related to various questions that you have if you're ever looking for help in the software. So I'll get rid of the inflows. Again, I'll drag that into the gallery. I'll get rid of all of the individualized pages to simplify the report. I'll get rid of the net worth statement details because I already have it in the snapshot. Perfect. So now that we've updated our included pages, we have a couple of options. We can leave this just for this single client, or I can go to defaults and I can save my new page settings for all new scenarios. And that's just going to create that template as my starting point in the future. So it saves you having to customize the report each time. Then I'll go to the report editor where I can view what's in each of those pages. So you'll see we have our cover page with a customizable logo and our background. We've got a note to reader, which is just a high-level disclaimer and compliance piece. And you can add customized text to any of these and then again, save your default for all new scenarios. Then we get into the snapshot section. We have the goal summary. So this is pre-populated by Snap to give you a starting point for your report. So we have when they retired, we have target retirement spending, target pre-retirement spending. In this case, there is no pre-retirement period. So we can simply get rid of that bullet. And then we can also add our own bullets if we want. So we have additional expenses for castle upkeep. Additional expenses for child support to children. So we can add our own bullets, we can use the existing, and then we can also include template variables. So on the right, you'll see that we can actually include the variable itself instead of having to hard code the client's retirement age or year, which could change. We can reference the variable, and that way, if we change the number in the future, we can automatically have that updated in the report. I click next, we'll go to the goal status. Here we can see that 153% funding. And what we can do is from the planning page, we can actually have Snap calculate some options for the client to consider. So if we go into recommendations, we have that 153% overfunded status, and we have some options available that might apply to each client's case. So if the clients weren't already retired, we could calculate how much earlier they could retire while still being on track. We could see how much they could take out today as a lump sum for a cottage purchase or a boat if they want to still be on track for their retirement. Or we can calculate the sustainable spending, which is how much they can spend each year of retirement in order to use up the projected surplus. So Snap will figure out how much more than 120,000 they could spend and let us know the total option. And we can also vary when this calculation is being based on. So right now I'm starting at the beginning of retirement, but I can actually customize the year that we start the sustainable if they want, say, 200,000 for a decade, and then they want to spend sustainably from that point on, we can change the start age for the calculation. But in this case, it's 169,000 that they could spend, which is about 50K a year more than their current target. So now that I've calculated that recommendation, if I go back into the report, it is pre-populated as an option available to them in order to use up the surplus if they want. Or we can again add our own bullet, leaving a larger estate. And we can continue on through each of the pages just to get a sense of what will be included. Or we can go to the top left and click on Report Preview in order to see everything in its current form. So we have our customized logo, our background, our note to the reader. We have that high-level executive summary with the goal summary, status, net worth, spending, current assets, and then their future estate. So a very nice summarized high-level view of the plan before you dive into some of the more detailed assumptions, charts, and tables. So that's the full workflow in Snap, going from scenario setup to planning pages to client report. We haven't been able to cover all of the functionality that's available in the software today. As I mentioned before, there's charitable donations, corporations. We have needs analysis to calculate whether there's enough life insurance, disability, or critical illness insurance in place. And all of this functionality is available for you when you do sign up for your free trial. You would be able to go to our help site. So if you click help in the top right and then help center, you can learn about all of our available functionality through previous webinars if you'd like. So we have kind of dedicated topics like modeling insurance coverage and needs analysis, fall refresher on our newest features, or you can also search for key terms or reach out to our support team by phone or email. With that, I'm going to pass it back over to Alex to walk us through a few next steps, and then we're going to open it up for questions.
Wow, Steve, thank you so much. So, as Steve just said, we have covered a lot this hour, but we are here to address any and all questions you have in just a moment. So keep them coming in. You can send them through the chat or through the Q&A tab. So let's pause here to do our second poll question for your CE credit. You should see that launching on your screen now. So this question, not quite as easy as the first. Why did we stress test the projections? Were we doing it just for fun? Were we trying to determine if lower than expected returns could impact the plan? Or were we trying to answer the question if they could afford to spend an additional $20,000 annually on luxury vacations? So I'll give you a few more seconds here to get your answers in. Most of you have responded, so a few more seconds. Why did we stress test the projections today? And again, if you're having any technical issues getting your answers to me, you can shoot me an email or just send it through the chat or Q&A tab, and we'll make sure we get those in. All right, I am going to end this poll now because we have got to move on. Perfect. Okay, so for those of you here today who are already using Snap, thank you so much for making time to be here with us today and for being a valued member of the Snap community. A reminder that you can be earning free months of Snap when you send referrals our way. This program is win-win. The referred advisor gets 50% off their first month of Snap, and the referring advisor, that's you, gets an entire free month of service when the advisor you sent becomes a paying user. If you are on annual billing, you will receive a $100 credit against your next renewal. There is no limit on how many times you can do this. 6 annual referrals would mean getting Snap free for half of the year. We have created a referrals page that you can access from within your Snap account that makes it easy to earn free months. Now, for those of you here today who are new to Snap and who cannot benefit from the referral program, we've got a special offer to help get you started with Snap. Valid for today only, 3 lucky advisors who start a 14-day free trial are going to win 50% off their first month of Snap projections. All advisors who sign up for a 14-day free trial today before midnight Eastern Time will be entered into the draw. The draw will happen on Thursday, which will result in 3 advisors who are new to SNAP getting 50% off their first month. You can scan that QR code that you see on the screen there. And I'm also going to send this out via email as well. So on the website, you'll see there are 2 plans for you to choose from as an independent advisor. The advisor business is the plan you want for access to the corporate module. If anyone would like to see that, let me know and we will try to cover it in the Q&A. You can upgrade and downgrade easily, so don't worry too much about which plan you select today. I'm going to drop the link in the chat now, so everybody should see this popping up here. And so this is a special link that you can use today to ensure that you get in to the draw for 50% off your first month. You'll also see that we have the option for annual billing. You can save big on annual billing. And you can also switch to annual billing at any time before the end of your free trial, once you've decided you're going to stick with us. So our last item before we move on to the Q&A will be our final poll question. So I am going to launch this here and you should see that popping up on your screen. So when we compared all 3 what-if scenarios using the comparison chart, what did we find? You've got 3 options here. Option number 1, even with making large transfer payments to their adult children or experiencing lower than expected returns, they're going to be okay. Option number 2, they will need to reduce their after-tax spending target by $25,678 annually, or they risk running out of money. Your third option, they should not loan cash to Sam unless they are going to charge him interest. So what did we determine when we compared all 3 what-if scenarios? So I'll give everyone a few more seconds here. Most of you have got your answers in. And again, if you're only having, if you are having any technical issues, just send it in through the chat or the Q&A, and I'll be sure to get these on for you. I will wait until tomorrow to submit the final report to the folks over at IAFP. So you've got plenty of time today to get in touch with me if we need to add in or modify any of your answers. All right, I am going to close the poll down now. Thank you so much, everyone, for getting your answers in. And with that, let's move on to the Q&A. So we've got lots of questions that have come in throughout this hour, Steve. We will cover all of the questions that we can, and anything we don't get to, we will follow up with you via email. So first question, can you pick and choose which funds are drawn first? In some situations, I would want to delay drawing from the TFSA.
Great question. Yes, you have full control over the withdrawal strategies in SNAP, and you have a couple options available to do that. So if we go into the individual planning page for Aragorn and we scroll across, we can see that SNAP is making withdrawals out of the joint checking account, out of the personal savings. It's taking the lift minimums. It's topping up the TFSA all the way until the end of the plan in this case, because they don't have a cash flow requirement to withdraw from it. But you can change the settings. So if we go into the settings and turn on the cash flow management order, we can change the order of withdrawals from the default, which is non-registered, then TFSA, then registered. We could change that to say non-registered, then RSP, and then TFSA last. And that way, even if they needed more for spending purposes, Snap would wait to take from the TFSA until they've depleted all of their assets. So that's one way that we can control the withdrawal strategy. Another option is that you can just directly change any account in any year. So if you want $10,000 coming out of the RSP, I can just enter in a $10,000 withdrawal, copy that down until age 71, and now I've customized what's coming out of that account for the year, and Snap will work around that and recalculate everything to reach the client's target spending from other resources. So now we have that spending. And another tool, which we just launched, is called taxable income targeting. So in this case, what we can do is we can turn on a new dedicated feature, and we can set a specific level of taxable income that we want to achieve throughout the plan. And we can base this off of marginal tax rates, tax credit thresholds, OAS clawback. And this is going to help us to optimally withdraw both from non-registered, registered, and TFSA assets. So for instance, if I want 93,000 a year of taxable income, and I want to copy that down until the bottom of the plan, and that's in today's dollars, and I want to index it, I can enter in that target, and then Snap is going to work as best as it can to blend withdrawals from various sources to achieve that target level of taxable income. So we can see it's getting as close as it can each year in order to maintain that. And so we've pushed out the OAS clawback all the way now until age 72, when the RIF minimums kick in and we're forced to take out more than we ideally want. And we could try different scenarios and optimize the target outcome for the client. And this is one thing that we're currently working on automating, is the ability to run different taxable income targets and government benefit start ages to get you a starting point that creates a very efficient and optimal drawdown, while still allowing you the same level of customization and final control over the plan in order to make refinements if you wish.
Fantastic, Steve. Thank you so much. Okay, next question. So this one is referring to when we were in the stress testing module. Can you just give us a brief overview of how that works, and the one specific question about it, are the values shown on the y-axis for the randomized scenario rounded to millions?
So in this chart, what these are showing is the value in each year of $1,000 starting. So if we start with 1,000 of spending need today, by the end of the plan, that's going to be 2,000 inflation adjusted. If we invest $1,000 in equity, by the end of the plan, it's going to be $3,000. So it's just giving us a relative increase or decrease in value over time. The numbers are being generated using a table, a customizable table of assumptions. So we have our average rates of return that we entered on our general plan settings. So that was the 2.1 inflation, cash, fixed income, and equity. And then we have standard deviations from historical data. And then we have a correlation matrix from historical data as well. So Snap uses this information to then create each year's expected values, and then that's what you can apply to your projection. And you can actually customize these assumptions. So if you don't want inflation changing year over year, you can set the standard deviation to 0 instead of 1.3. And that's just going to keep a static inflation component, or similar with cash. If you just want to simplify and show a cash savings account not fluctuating in returns over time, you would just set the standard deviation to 0. So you can customize how you use the stress testing to create the different circumstances, and then you would select which plan you want to apply to your projection. So now we can see the cash and inflation are no longer fluctuating over time. They're just statically increasing at their set rates. We do have webinars and dedicated articles that help to explain the functionality in more detail. So if you are interested in learning more, you can enable the feature. This is our only paid add-on in Snap. When we were speaking with advisors initially, they either said they'd want it frequently or they wouldn't need it for their specific client cases and discussions. So we added it as an optional paid add-on. It's $9 a month and it's only billed during the period while you're turning it on.
Perfect, Steve. Thank you. And then just one more question on that has come in while you were looking at that. What would be the use cases and the sort of the best practices in using the stress tested projections versus the actual projections, and how would you like position that with the client to explain the value in stress testing?
Yeah, so there's really lots of opportunities to use this sort of analysis in your discussions. The most common way is just as a sanity check or putting a client's mind at ease. So after we did scenario 2, we copied it and ran a stress tested scenario to show lower than expected returns. So basically saying, okay, we don't want to, you know, fall apart if returns are 1 or 2% lower than what we've modeled. We want to make sure that there's buffer there so we can run the plan and show them what their estate would be with lower returns. We could also, if there is a shortfall in the plan, we can use the recommendations module to calculate their sustainable spending. So this approach can help you to create what's referred to as the bumper rails or the guardrail approach to retirement spending, where you don't want to guarantee a specific level of spending because things will change over time, but you can give them a range of expected outcomes that they should be able to accomplish. So you should be able to spend somewhere between 80 and 120,000 a year. We'll target 100 and we'll adapt over time. If they're not able to drop to 80, then you'd want to have discussions about whether you can annuitize their income or whether they can work longer. So it helps to have discussions about future outcomes and variability and how their plan will weather future unexpected events. Another great circumstance where this analysis comes up is related to pension versus commuted values. So you can model the outcome where the client invests at an expected rate of return, but then show that a pension would have lower variability in future outcomes because there's less exposure to the market risk. So this helps to kind of illustrate the differences in changes to the plan if returns are lower than expected. And then there's kind of countless others. There's sequence of return risk. So talking about the returns that you get in specific periods and how those impact your plan, and then just variability in general.
Fantastic. Thank you, Steve. Okay, so still lots of questions. We've just got 2 minutes here. So the last one I'm going to tackle is what retirement visual calculators do we have when we want clients just to look at something like high level quickly without going into full detail with the software?
Yeah, so Snap is designed to be simple enough where you can create this high-level chart of their expected net worth over time without needing much information, right? If you just have their account balances, their age, you can use the default government benefit assumptions, and you can very quickly create charts that show their net worth or their spending capacity over time. So we have previous webinars where we kind of create quick and simple projections for clients in as little as 5 minutes. Now, there's not standalone calculators in Snap, which might be what you're used to using. Our goal or our hope is that you can create a more high quality result in similar time just using the standalone functionality in Snap to create more of a full plan. But if you do have any specific use cases that you'd like to discuss, our support team is happy to guide you through what the best approach would be to replicate that quickly.
Fantastic. Thank you, Steve. Okay, well, we are just about on the hour, so we are going to wrap this up. I'm sure many of you have meetings you have to hop on to. So we've gone over everything for the CE credit as well as the special offer. I will be following up with everyone via email to address any further questions or concerns around your poll responses. Thank you so much for being here with us today. And I hope this has been a valuable session for all of you. And I am sure we will chat soon. Bye for now.